We've talked previously about all the money tools that are available out there. And certainly there's a lot of different names and products. But what's important to understand is that at the core, they all boil down to one of three things. And they serve as our financial tools that we use to accomplish various objectives. Corresponding with those money tools are going to be what I like to call the money toolboxes. And effectively, what these are the various different types of financial accounts that we can put our money tools in. So, right, we have all the different types of financial tools, stocks, bonds, mutual funds, cash, etc. And then we have like a bank account where your cash actually goes into, or like a 401k that mutual funds go into. And those are ones people have heard about for the most part. I could talk for hours about a 403b versus a 401k versus a 457 versus a IRA versus a beneficiary IRA versus a Roth IRA, right? We could be here all day. And maybe I would impress you with all the little details that I could rattle off, but you would be left with just a bunch of specific tactical information that's not really helpful to make a practical decision on. But through all those different toolboxes or different types of accounts, similarly to the tools themselves, which is really just three, on the toolbox side, there's really just two. There's two types of accounts that people need to understand very well. One is going to be a retirement account. The other is going to be a non-retirement account. We love that in financial advising. This is a retirement account, and this is a non-retirement account. So if we can understand the retirement account, the non-retirement account is literally everything else. When you think about retirement accounts, first of all, is how do we identify them, right? I call it the rules of threes and fours. They're almost always abbreviated with 3 to 4 letters or numbers. For example, 401k, an IRA, a Roth IRA, a 457, a 403b. Very commonly is going to be 3 or 4 numbers. These retirement accounts, they're referred to in a lot of different ways. Sometimes they're called qualified accounts or tax advantaged accounts. They're all kind of talking about the same retirement accounts. But that's important to understand that these have a special tax status given to them by the IRS, the federal government. Because they have a special tax status, anytime money leaves that account, the IRS is watching. And so it is very important that you have a firm understanding of what those tax implications are going to be before you take the money out, because once the money comes out, they become real. To have all the specifics of that, it's important to talk to a tax professional. But one that's very common is that before age 59 and a half, there's usually a penalty. So anytime you're in a retirement account, you want to make sure that you are planning to keep that money in there until age 59 and a half. And if you do that, though, there are certainly a lot of benefits. I'll give you an example of how this works, right? So a 401k is a retirement account, okay? Because it's a retirement account, you can put money in there and invest in different financial tools. Let's just say you put $100 in there. You can decide to pay taxes on that $100 right now. The money goes in, it can grow, it can go up and down, all these sorts of things. And at the end, when you take money out, in this situation, because you pay taxes up front, you always pay taxes one time. When the money comes out, you're not going to pay taxes again if you meet the qualified distribution rules for that specific qualified account, which whole separate conversation. This is why it is very important to talk to a tax professional. Conversely, you can decide to not pay taxes on that $100. The money gets invested, it can grow, go down, who knows? Because you haven't paid taxes on that $100 when it went in, you actually probably got a tax deduction on that. You didn't pay taxes on that. When the money comes out, because everything is taxed once, you are going to owe taxes on that. And unless you are meeting the qualified distribution rules for that specific account, which 59 and a half is usually the first rule for the qualified distribution, you are going to have to pay an additional penalty on that too. So again, special tax provisions and age 59 and a half are like the big two things that come with that. So to recap, we got the qualified accounts, retirement accounts. They are going to be threes and fours. So on the other side is a non-retirement account. And this is literally everything else that's not a retirement account. Your bank account is a non-retirement account. We also call them non-qualified accounts. You could also have a investment account that is not a 401k. It's not a bank account, obviously, because you don't hold cash. You hold investments or tools in it, but it's going to be non-qualified. There is no special tax provision. So because of that, regular tax rules apply, which is every dollar is going to be taxed once. So if you put $100 into that, if that $100 was from income, then you pay taxes on that when it became income. It's already been taxed. You invest that $100. If it grows to $105, that is $100 that you pay taxes on and $5 that you haven't. When the money comes out, you're going to be taxed on $5. What's really important to understand is that with all the different toolboxes out there are two that matter. And the reason why they matter, because it changes how you're going to pay taxes. And that's what's most important to understand.